What if I told you there was a way to write off your medical expenses completely tax-free that most individuals miss every single year? I'm not lying. The rumors are true, and that's our focus in today's video. Guys, hello, my name is Andrew D'Amico. I'm a CPA, former college athlete, and most importantly, a partner here at ScheduleA alongside my partner Mike, where we coach and advise our clients to help them save on taxes, improve their asset protection, and build generational wealth. If any of those three items speak volumes to you, please make sure you're subscribing to this channel so you can get the latest and greatest from our weekly videos. But now let's get into it. Medical. Okay, how do we deduct our medical expenses? Well, first we need to understand the methodology that most taxpayers use, and they have no idea how inefficient it really is. And that's through itemizing on Schedule A. You notice on my whiteboard here, I have itemized deductions on the left, the standard deduction on the right. The IRS allows you to take either the standard or itemize them yourself every single year on your tax return. And what that is it's a deduction which reduces your taxable income, which reduces your taxes owed. So obviously, the higher the deduction, the lower the tax. The standard is just the rate that the IRS throws together every year, and it depends entirely on your filing status. Not gonna read them all, but you can see single, married filing separately, married filing joint, and head of household. Me, I'm single, so if I were to take the standard deduction on my 2025 tax return, I could take a deduction for $15,750. However, I would first wanna compare that to itemized deductions. Can I capture enough itemized deductions that's gonna be greater than the standard? Because then I would want to take that because it provides greater tax savings. So the main four buckets of items that are in the itemized bucket, which you would fill out on Schedule A, are state and local taxes. And now that cap used to be at $10,000, but with Trump's new One Big Beautiful Bill, that cap has been increased to $40,000. And the other buckets include any home mortgage interest, charitable contributions, and then our focus of today's topic, right, medical, down here at the bottom. But we should really have an asterisk here, because it's not like you just get to take all your medical expenses. There's actually a calculation that the IRS makes you jump through in order to calculate your deductible medical expenses. So let's draw that up. And then while I'm erasing this, we'll pull up on screen a snippet of a Schedule A. And you can see up here, this is the calculation you gotta jump through to get your medical deduction. So first, it says you need to pull your AGI from page 1 of your 1040. So we need to find our AGI, and that's going to include any income items you have, right? So there's going to be any W-2s you have. Do you have brokerage interest accounts, dividends, capital gains, losses? Do you have a side hustle or a small business where you're filling out a Schedule C, or you have a K-1? All income items flow down to your AGI. And just for example's sake, let's say that's 100K, just so we can go through this calculation, because the IRS says you need to have medical expenses in excess of 7.5% of AGI. So if we apply that methodology here, right, we're gonna say times 0.075, that looks like $7,500, right? Simple math, keep it simple. Now, you're gonna tally up all your medical deductions for the year, and anything that's greater than the 7,500, you're gonna be able to deduct on Schedule A. So if I incurred $8,000, I am only going to get a $500 deduction on my tax. And let's say I'm in a 30% tax bracket, let's say 24% federal, 6% state. That's only like $150 in tax savings. Right, we'll say rate. So I paid $8,000 in medical out of pocket, doctor visits, prescriptions, dental visits, my kids' dental visits, medical doctor visits, whatever. You incurred $8,000 and you got a whopping $150 in savings. Not so great. And not for nothing, pivot back to my previous board, you need to itemize in order to even get this $150 in savings. So if you don't own your home, or you don't pay a lot in state and local income tax, you can kiss the medical deduction goodbye on Schedule A. You're not getting it. If that standard deduction is greater than all your itemized deductions, none of this even matters. You're gonna get zilch, nada, nothing. So, my friends, enter in the HSA, the health savings account. This is what well-informed taxpayers and the wealthy people do in order to write off their medical, because they don't need to do that whole song and dance with the calculation. No, you get to deduct any contributions to the plan. And what does that look like? So we're gonna have our HSA. So you need to have a high deductible health insurance plan. Now, this could be if you're single or if you're on a family plan. But for my single people out there, the annual contribution limit for 2025 is $4,300. And if you're on a family plan, you need a better marker, is $8,550. And these are the contribution limits. This isn't saying how much I'm limited in medical that I need to pay out. No. How it works with the HSA is you contribute monies to the plan, you incur medical expenses, and then you reimburse yourself tax-free from the account. So not only am I getting a tax deduction on the way in, I get to reimburse myself tax-free, and I got the deduction for it. You don't see that with many things in the code. And I can't stress this enough, there's no song and dance on Schedule A. You don't need to itemize in order to do this. You can take the standard deduction and do this. You can itemize and do this, and not report any medical expenses. And we're only focused on the contributions. These are contributions. So let's say I had a down year, like in a good way. I didn't need to go to the doctor for many things. Maybe I had a couple dental visits. I only paid $1,000. That's fine. You're not limited to $1,000 deduction. You get a deduction for however much money you put in, again, up to the cap for the year. So you could be stockpiling these contributions year over year, getting a $4,300 deduction every single year. And then one year, maybe you have a kid, you get in an accident, you have a major surgery, something bad happens, your medical expenses spike, you can now reimburse yourself tax-free from that account you've been building for the past several years. And what's the immediate tax impact? Let's say, like before, right? We're in a 30% tax bracket, just to make this simple. If we apply that to either or, you're looking at tax savings for a single person. Sorry, marker's really letting me down here, so we're gonna switch over to blue. For that single person, that's gonna equate to about $1,300. And then if I'm on the family plan, that's going to be over $2,500 if I were to contribute the max. That's a far cry from the $150 in tax savings we saw on Schedule A. And again, if you go back, if your AGI is greater than $100,000, then you need to incur even more medical expenses to see any sort of benefit. And if I could just bring it home here with a few more words or side-by-side comparison, if you will. If I'm stuck on Schedule A, what am I stuck with? I have a calculation, right? 7.5%. So it's going to limit my ability to deduct the medical. I don't get tax-free reimbursement, and I'm not putting any money away. It's not in an account. I can't invest this thing. So no investment. Whereas the HSA, this thing's like a triple threat. This is like the creme de la creme, if you will. So you get a tax deduction. You can invest this and grow tax-free, much like a Roth. So when you get the money out, it's going to come out tax-free, so tax-free reimbursement. And then if you're familiar with the concept of self-directing, we get to play in that pool as well, where you can open up your investment strategy beyond stocks, bonds, and mutual funds. You can invest your HSA in a cryptocurrency, in real estate, in private lending. So if you got the wherewithal, you got the motivation, you can go out and earn higher returns with this bucket of money that's going to grow tax-free. This is just one of the many tax strategies we advise our clients on. If you're stuck on Schedule A, know that you can do it, but it's a losing formula, and you're leaving thousands of dollars in savings and tax-free reimbursements and tax-free investment growth on the table without the HSA. So please leave your comments and questions, subscribe to this channel, and get in touch with us if you'd like to learn more about this strategy, among several others.